Welcome back to another episode of Simple Mind Space. Today's episode is dedicated to a topic that many of you have been asking for: how to double your money. It's a question that sparks curiosity and hope in all of us. But before we dive into the exciting world of investments and explore the various avenues to multiply your wealth, let's address the elephant in the room, the biggest obstacle that stands between most people and their journey to financial freedom. Believe it or not, it's not the lack of investment knowledge or access to complex financial instruments. The real hurdle, my friends, is much simpler and often overlooked. Most people simply don't have enough money saved to begin with. Don't believe me? Here's a startling statistic that underscores this very point. A staggering 52% of millennials, those aged between 18 and 37, have less than $1,000 in savings. Let that sink in for a moment. Now, some might argue that millennials are just starting out and their financial situation will improve over time. But hold on, because it gets even more concerning. Only a meager 16.5% of millennials have managed to accumulate over $20,000 in savings. This begs the question, why is saving such a struggle for so many? The answer, my friends, lies in 5 key challenges: income, expenses, taxes, investments, and identity. Let's break down each of these challenges and understand how they impact your ability to not just double your money, but to build a solid financial foundation. Income versus expenses, the balancing act. When we talk about income, it's easy to get caught up in the allure of a high salary. But the truth is, a big income doesn't necessarily translate to financial security if your expenses are outpacing your earnings. It's not about how much you make, but how much you keep that truly matters. Let me illustrate this with 2 simple examples. Example 1. Imagine someone earning a handsome $250,000 a year, a $250,000 income that many aspire to achieve. However, this individual also happens to spend a whopping $280,000 annually. This means they are losing $30,000 every year. Sadly, this scenario is more common than you think. I personally know countless individuals who fall into this trap of outspending their income. Example 2. Now, contrast this with someone earning a more modest $80,000 a year. This person, however, has a firm grip on their expenses, limiting them to $60,000 annually. The result? They are able to save a respectable $20,000 each year. The takeaway here is crystal clear. The individual earning $80,000 is actually saving more money than the one making a $250,000. This highlights the importance of not just focusing on increasing your income, but also on keeping your expenses in check. Boosting your income, it's time for a side hustle. Now, if you find yourself in a situation where you need to increase your income, it's time to roll up your sleeves and get to work. The days of coming home from your 9 to 5 and spending hours glued to Netflix are over. If you're serious about financial freedom, you need to start thinking about building additional income streams. This could involve starting a side hustle. What skills or passions can you monetize? Explore freelance opportunities, online businesses, or even something as simple as selling products or services you're passionate about. Investing in your skills. In today's rapidly evolving job market, continuous learning is no longer optional, it's essential. Invest in upgrading your skills, acquiring new ones, or even pursuing certifications that can boost your earning potential. Working overtime or taking on a second job. This might not be the most glamorous option, but it's a tried and tested way to increase your income in the short term. Remember, the name of the game is to increase your income and create a wider gap between what you earn and what you spend. Mastering your expenses, renegotiate, and live below your means. Now, let's shift gears and talk about expenses. Here are a few powerful strategies to help you gain control of your spending. Renegotiate everything. Go through your monthly expenses with a fine-tooth comb and renegotiate every single contract, bill, and recurring expense. This includes your phone bill, cable bill, internet bill, gym membership, insurance premiums, you name it. Don't be afraid to ask for discounts, explore competitor offers, and leverage your loyalty as a customer. Fire your consultants. Embrace technology. In today's digital age, there's no excuse for paying exorbitant fees for services that can be easily outsourced online. Websites like Fiverr offer a plethora of affordable freelancers who can handle everything from website design and logo creation to copywriting, voiceovers, and virtual assistants. By leveraging technology and tapping into the gig economy, you can significantly reduce your business overhead and free up more capital to invest. Live below your means. This age-old advice might seem like a no-brainer, but it's astonishing how many people struggle to embrace it. Living below your means doesn't mean depriving yourself. It simply means being mindful of your spending habits and making conscious choices that align with your financial goals. Delay gratification. Resist the urge to keep up with the Joneses and fall into the trap of consumerism. Delaying gratification and prioritizing long-term financial well-being over short-term indulgences is crucial for building wealth. Remember, every dollar you save is a dollar you can invest and put to work for you. The power of identity, shifting your mindset for financial success. Now, let's talk about a less tangible but equally important factor that influences your financial well-being: your identity. Your identity, when it comes to money, is essentially your self-perception of what you deserve and what you believe is possible for you financially. If you have a limiting belief system around money and see yourself as someone who is destined to struggle financially, you're likely to sabotage your own efforts, even subconsciously. On the other hand, if you cultivate a positive and abundant money mindset, believe in your ability to create wealth, and see yourself as deserving of financial success, you'll naturally attract opportunities and make decisions that support your financial goals. Doubling your money, understanding the Rule of 72 and 105. Now let's delve into the exciting part: how to actually double your money. This is where the Rule of 72 and its lesser-known cousin, the Rule of 105, come into play. Rule of 72. This simple yet powerful formula helps you estimate how long it will take for your money to double, given a fixed annual rate of return. To calculate, you simply divide 72 by the annual interest rate. For example, if you invest in an asset that yields a 7% annual return, it will take approximately 10.29 years, 72 per 7 equals 10.29, for your initial investment to double. The beauty of this rule lies in its simplicity and versatility. You can apply it to various investment vehicles, from savings accounts to stocks, bonds, and real estate. Rule of 105. This rule follows the same principle as the Rule of 72, but instead of doubling, it helps you determine how long it will take for your money to triple. Simply divide 105 by the annual interest rate. Investing wisely, navigating the world of investment options. Now that you understand the time value of money and how compounding can work its magic, let's explore some common investment avenues. 1. Stocks. Owning a piece of the pie. Stocks represent ownership in publicly traded companies. When you invest in stocks, you're essentially buying a small stake in a company and participating in its potential growth and profitability. Types of stocks: small cap stocks. These represent companies with a smaller market capitalization, typically in their early growth stages. They offer higher growth potential, but also come with higher risk. Mid-cap stocks. These fall between small cap and large cap stocks, representing companies with a moderate market capitalization and a more established track record. Large cap stocks. These represent well-established blue-chip companies with a large market capitalization, offering stability and consistent dividends, but with moderate growth potential. Investing in stocks, research and due diligence. Before investing in any stock, thoroughly research the company, its financials, industry trends, and competitive landscape. Long-term perspective. Stock market investments are best suited for long-term goals, as short-term fluctuations are inevitable. Ride out the market volatility and focus on the long-term growth potential. Diversification. Don't put all your eggs in one basket. Diversify your stock portfolio across different sectors, industries, and company sizes to mitigate risk. 2. Bonds, lending for a fixed return. Bonds are essentially debt securities. When you invest in bonds, you're lending money to a government entity or corporation. In return, the issuer promises to pay you a fixed interest rate, coupon payments, over a specific period, and return your principal investment upon maturity. Types of bonds. Corporate bonds, issued by corporations to raise capital. Government bonds, issued by governments to finance public spending. Municipal bonds, issued by states, municipalities, or counties to fund public projects. Investing in bonds, interest rate risk. Bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall and vice versa. Credit risk. The creditworthiness of the bond issuer determines the risk of default. 3. Real estate, tangible assets with potential. Real estate investing involves buying, holding, managing, renting, or selling properties for profit. It offers both potential for appreciation in value over time and the possibility of generating rental income. Types of real estate investments. Residential real estate includes single-family homes, townhouses, condos, and multifamily properties. Commercial real estate encompasses office buildings, retail spaces, industrial properties, and hotels. Industrial real estate includes warehouses, distribution centers, and manufacturing facilities. Investing in real estate. Location, location, location. The value of real estate is heavily influenced by its location. Market cycles. Real estate markets are cyclical, experiencing periods of growth and decline. Property management. Owning rental properties requires time, effort, and expertise in property management. 4. Entrepreneurship. Building your own empire. While not a traditional investment class, entrepreneurship, in my opinion, offers the greatest potential for wealth creation and financial freedom. It's about identifying opportunities, solving problems, and building a business around your passions and skills. Benefits of entrepreneurship. Unlimited earning potential. Unlike a traditional job with a fixed salary, entrepreneurship allows you to scale your income based on your efforts and the success of your business. Control over your destiny. You're in the driver's seat, making decisions that shape the direction of your business and your financial future. Passion and purpose. Building a business around your passions can be incredibly fulfilling and motivating. Challenges of entrepreneurship. Risk and uncertainty. Starting and running a business comes with inherent risks and uncertainties. Hard work and dedication. Building a successful business requires relentless effort, long hours, and unwavering dedication. Financial commitment. Starting a business often requires upfront investment and careful financial planning. The bottom line, your journey to financial freedom. Remember, the key to doubling your money and achieving financial freedom lies in adopting a holistic approach that encompasses saving diligently, managing expenses wisely, investing strategically, and constantly expanding your knowledge and skills. Whether you choose to invest in stocks, bonds, real estate, or embark on the thrilling journey of entrepreneurship, the most important factor is to approach your financial decisions with a long-term perspective, a commitment to continuous learning, and an unwavering belief in your ability to create wealth and achieve your financial goals. That's all for today's episode. If you found this valuable, hit that like button, share it with someone who needs to hear this message, and subscribe to the channel for more empowering content. And don't forget to drop your questions and thoughts in the comments below. I'm always here to help you on your journey to financial success. Until next time, stay focused, stay driven, and keep hustling towards your dreams.